Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Steve Sosnick, Chief Market Strategist at Interactive Brokers, to discuss how the market is interpreting Fed policy and if it is getting ahead of itself. Steve, it's great to see you as always. Welcome back to Trade Talks.
Thank you so much, Jill. As you know, it's always a pleasure.
Thank you. And let's first start with the employment data we got this morning. Looks like the economy is firing on all cylinders here.
Yeah, I mean, this number was eye-popping, astounding. I run out of adjectives for this one. We coming in at 517 versus an expectation of 188. And then when you throw in that there was a positive revision for December, we're talking really about 3 times the number of jobs being created as the market was expected, plus or minus a little less. But still, that is amazing. And I think that's kind of why the chairman was more or less willing to let the data do the talking rather than himself do the talking on Wednesday, because I don't know that he knew this data was coming. That would be presumptuous of me. But I guess he's been reading the data and saying that these numbers are going to come in strong. Let the market do his dirty work rather than him do his dirty work. But as with anything else, the market's looking for something positive to grasp to, and what it's grasping on today is the fact that average hourly earnings for the month were up 0.3, which was as expected. So we're not getting any worse on the labor inflation front, even though the numbers remain strong. Mind you, that's still well above 2% when you annualize, the 0.3, that annualizes to a bit over 3.6, but still, the traders right now want anything that resembles good news, and they got the one piece of data that they could pick out, even if on the surface the payrolls number should be market unfriendly let me say market unfriendly to a market that hopes the Fed will pause and pivot. It's not necessarily market unfriendly if you think we're going to skirt a recession.
Right. Well, and that's a good point too, right? The recession, it doesn't feel like we're in one, right? So, but I feel as if though the market is kind of way ahead of itself here. Hopium isn't exactly the best investment strategy, but corporate earnings are okay. Nothing great, nothing disastrous, and it feels as if everything is predicated on the Fed. I don't think there was any policy shift or change in composure when Powell was speaking on Wednesday at the press conference, and I think this will give him more ammunition to tighten further, or at least not reverse and pivot. And I don't think this Fed is going to want to make the mistake that we saw in the 70s.
Oh, absolutely not. There's a piece that should be coming up on our website. It's not up yet. It's still working its way through the compliance channels and everything else. But my point today that I'm working on today is that if you remember the July meeting when he used the term neutral, basically saying we're at a neutral policy, which by the way was 2.25, 2.25 to 2.5. So that's way in the rearview mirror. But at the time, the market took that word neutral and ran with it. Similar circumstances, we were coming off the June lows. The July earnings season was not as bad as feared, which is, I think, probably the best way to refer to the current earnings season, better than feared. And I think the markets were really, poised for good news then. They're poised for good news now. And so when he used the term disinflation, it was interpreted similarly to when he used the term neutral. Now, let's be clear, disinflation is a second order effect. What it's saying is prices are rising, but they're rising more slowly than they had been. That still doesn't mean we've beaten back inflation. It just means that, we're making some headway. And I think making some headway versus declaring the battle over is a bit of a stretch. But, as you know, psychology rules. And when we last spoke, I mentioned how I thought that the market had been propelled largely by January effect. Some of the stocks that have been beaten down worst into December were leading the rally in January. It persists now. And so, it's a tape that's very, very hard to fight. Even if when you step back and say, okay, there's basically two scenarios. Either the bond market is right and we're going to get a recession later in the year and deal with it, which is not good for stocks, or the economy is going great guns, but in which case we probably shouldn't be expecting the Fed to cut rates by the end of the year. And by the way, there's no indication from their rhetoric that they're going to. Right. So it is easy to that we've gotten ahead of ourselves. Hopefully we're able to thread that needle, but it's not necessarily a high probability outcome that the market is pricing in right now.
Right. Well, Steve, you know what my concern is that we run the risk of everything going from the bottom left of the chart to the upper right, and valuations just get disregarded, and we're not looking at the core underlying fundamentals. That's the same trap that we ran into, and you know, in the beginning of 2022, we saw the effect that it had, and then you throw in a war, and then you throw in, you know, other things that pop up all the time. I'm just concerned that we run the risk of ignoring valuations. Look, I'm happy for my portfolio. It's nice to see your retirement come back a bit, but I just, you know, everything is so short-term memory when it comes to the market.
Absolutely. You know, what's interesting to me is when you see bonds and stocks rallying together, which we're not seeing today. We are seeing them diverge, but for the most part, we've seen stocks and bonds both rally. Bond yields lower, stock prices higher. That doesn't really happen unless monetary conditions are easing, because it means people are just looking for some place to get some return for their money. Yet the Fed continues to tighten. There's quantitative tightening out there. But through all this, monetary conditions seem to have eased. Powell really kind of brushed off that idea at the press conference, you know, seeming almost in disbelief or disregarding some of the statistics we've seen. But that's really where it comes down to. You know, are we in an environment where money is just chasing returns, or money really thinking clearly about where the best, you know, combination of risk return are? You know, but markets can do what they want to do, and they get momentum driven. We're being driven right now by momentum. It's not necessarily anything wrong with that, but the risk is that you get too carried away with that and turn trading into investing, and that can be, you do need to separate them from time to time, or much of the time.
All right, Steve, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.